The RIMC model is the most powerful when we're using it to understand narrative and direction to trade in. So here we're on the 12-hour chart. The reason we're on the 12-hour chart and we always start from those higher time frame charts is because if we're just taking RIMC, which is sideways range, initiation, mitigation, continuation, this is the RIMC model. This gives us an understanding of direction from points of mitigation from previous sideways ranges. If we use this on a 15-minute chart, we can anticipate potential 10 to 20 pip reactions, which is great if we have stop losses of like 1 to 2 pips. Now, if we want to understand a higher time frame direction, we need to go and use the RIMC on the higher time frame. So when we're using it on a 12-hour chart, these reactions that we see are more likely to be hundreds of pips worth of moves, which gives us direction for a few days within the market and gives us higher risk to rewards with bigger and safer stop losses. So if we just look at the chart right now, this is a doji candle here, which represents a sideways range on the lower time frame. That doji candle has initiated and created this high within the market. So that's the first part of the RIMC method. Range and initiation creates a high. When we pull back into this sideways range here in the future, this is the mitigation phase. This is where we're always looking to take our trades from. And then if we play a continuation, price is going to target this previous high. This gives us direction within the market. So let's just mark that out. Now, if we look on the other side as well, this is also a sideways ranging market before price is initiated here to the downside. Price is now pulling back into this previous sideways range. So if we react from this sideways range here and we actually follow through and see continuation to the downside, price is then going to target this low down here. Now we've just mapped out direction within the market from points of mitigation where we can look to trade these directions in the future. Now the most important thing is that when we zoom into the lower time frames, we want to look for continuation structures away from these locations so that we don't just trade random points within the market. Price is actually showing us that it wants to move in that direction. Really important.